If you are self-employed, you have access to retirement plans that may grant you 3 to 10 times more tax benefits than ordinary people, allowing you to save massive amounts of money in taxes. I'm talking about the ability to defer up to $285,000 of your income or more in one given year, depending on the circumstances. But here's the problem I see a lot of times. Most self-employed individuals are either using the wrong retirement plan or missing out on these benefits entirely because they don't understand which one of these plans are best for their situation. There are different types of IRAs, 401ks, and even pension plans that can make all of this very confusing. And then on top of that, there are different structures you can use, like Roth versus traditional accounts, which each having their own pros and cons. So in this video, I'm going to give you a very simple framework to help you choose the best retirement plan available to you as a licensed CPA that tax plans for business owners every day at mycpacoach.com. So if you want to maximize your retirement contributions and minimize your taxes, go ahead and save this video, hit the like button below, and let's go ahead and jump in. Okay, so first you need to understand why being self-employed gives you such a massive advantage when it comes to saving for your retirement. And it is because as a self-employed individual, you actually wear two hats in your business. You are both the employee and the employer in your business. And when it comes to retirement plans, they often have employee contribution limits as well as employer contribution limits, which means as a self-employed individual, you can take advantage of both of these sides, which can dramatically increase the amount of money you can put away for your retirement. Plus, you can structure these ways in a way so that every dollar you put into these plans actually creates a tax deduction for you that directly reduces your taxable income and your taxes. For example, someone in the 37% tax bracket who puts $70,000 into a traditional retirement structure could save nearly $26,000 in taxes that year alone. Traditional retirement plans grant you a dollar for dollar tax deduction for each dollar that you put into it, up to the maximum limits, which can be very beneficial for business owners in very high tax brackets right now who expect to be in lower ones when they retire. But on the other hand, for business owners in low tax brackets right now who expect to be in a higher tax bracket when they retire, may benefit more from a Roth retirement structure, so they may want to consider that as well. But depending on the type of retirement plan you choose, you may be able to do one of these structures or a mix of them depending on your objectives. But regardless, most people will want to choose a structure that allows them to put the most amount of money inside of these plans while offering them the greatest tax benefits possible. So let's go ahead and break down your options, starting with the simplest and working our way up to the most powerful. So let's go ahead and start with the basics in level 1, individual retirement accounts or IRAs. This is the simplest retirement plan available, and almost anyone with earned income can set one up for free at a financial institution of their choice in just a few minutes. But how exactly does it work? Well, with traditional IRAs, you are able to contribute up to $7,000 per year or $8,000 if you are over the age of 50, which may be tax deductible if you meet certain criteria. You could also opt for a Roth IRA instead, which have the same contribution limits, but you would be using after-tax dollars, meaning you would not receive any immediate tax benefits in the first year and would instead be opting for future tax benefits during retirement. But here's the major problem with IRAs in general. If you are earning significant self-employment income, a $7,000 to $8,000 contribution limit is not going to move the needle much on your taxes or your retirement savings. Plus, there are income limitations that can reduce or eliminate your ability to deduct your traditional IRA contributions if you earn too much. As a CPA, most of my clients either A, make too much income to qualify for these plans, or B, desire to put way more money inside of them than these limits. And if that's you, let's go ahead and move on to level 2, simple IRAs. Now, simple IRAs are business retirement plans that are intended to be simple, as you can tell from the name. It tends to work best for businesses with either no employees or under 100 employees who just want something very easy to administer. With a simple IRA, you can put up to $16,500 of your wages as an employee of your business, plus $3,500 if you're over 50. And then as an employer, you can also put up to 3% of your compensation as an employer match. For example, if you earned $100,000, you may be able to contribute $16,500 as an employee and another $3,000 as an employer match, giving you a total contribution of $19,500. So when compared to regular IRAs, you are able to put almost 3 times as much into these plans. Plus, some people also find it much easier to administer, as well as less expensive when compared to traditional 401ks, which we'll talk about. However, these contribution limits are still relatively low when compared to some of the other options available to self-employed individuals, like with level 3, SEP IRAs. SEP IRAs, or Simplified Employee Pension IRAs, allow you to contribute up to 25% of your self-employment income or wages up to a maximum of $70,000. For example, if we have $100,000 in income from our business, we may be able to put up to $25,000 of that income towards our retirement, which is a bit higher than what we saw with the simple IRAs. Plus, SEP IRAs are also known for their simplicity as well. They are very easy to set up and maintain and typically have no annual filing requirements, but there are some significant limitations. First, there is no employee contribution component here, so you need higher income than some of the other options we'll talk about to max this out. Plus, if you have employees, you must also contribute the same percentage for everyone in your business. There's also no Roth option with these plans and no loan provisions. So like I said, SEP IRAs are great if you want something simple and easy to administer, but if you want maximum contributions, then you might want to consider level 4 here, traditional 401ks. Traditional 401ks are employer-sponsored retirement plans that most people may know from their W-2 jobs. But as a self-employed individual, you can set up a 401k through your business and contribute to those plans as both the employee and the employer. For example, employee contribution limits are limited to $23,500 in 2025 or $31,000 if you're over the age of 50. Plus, employer contributions can be up to 25% of your compensation, allowing you to make a total of $70,000 in contributions or $77,500 if you're over the age of 50. Plus, another advantage of traditional 401ks is that they work well if you have employees. You can offer this same plan to everyone, and you have flexibility on the employer match percentage. You can set a very high employer match or none at all, while allowing you and your employees to take advantage of the individual contribution limits. But there are some disadvantages of these plans. They typically have higher administrative costs, annual filing requirements if you have significant assets in these plans, and complexity in the setup and maintenance of them. You will usually have to get a third-party company involved to manage all of this for you. But traditional 401ks are typically best if you have employees and you want to offer them a robust retirement benefit while maximizing your own contributions. However, if you do not have employees in your business, you might benefit more from level 5, solo 401ks. Solo 401ks are specifically designed for self-employed individuals with no employees other than a spouse. And here's why solo 401ks are so powerful. So first and foremost, you can set the highest employer match percentage possible, which is 25%, while still benefiting from the employee contribution component as well, giving you the highest 401k deduction possible. With traditional 401ks, employers can offer a 25% match, but rarely do when they have employees because that would make those plans very expensive to maintain. However, with solo 401ks, you are typically the sole employee covered by that plan, meaning you can comfortably set the highest match percentage possible, which would be to your own benefit. The second major benefit of these plans is that administering these plans are much less complex and less expensive when compared to traditional 401k plans. You can typically set up a solo 401k for free at many places, while traditional 401k plans often come with much higher monthly and annual fees. And third, unlike SEP IRAs, there is an employee component this time, allowing you to reach that maximum contribution with much lower levels of income. For example, to max out a solo 401k at $70,000, you would need about $185,000 in self-employment income. But to max out a SEP IRA at the same amount, you would need $280,000 in income. That's almost $100,000 more, and that's due to the employee and employer components. The only major downside of these plans is that when you hire employees, you would need to switch to a different plan, like a traditional 401k. Solo 401ks are perfect if you are a solo entrepreneur or work with just your spouse and want maximum contribution flexibility from a 401k perspective. But there's still one retirement plan structure that may allow you to go above and beyond these limitations in level 6. Cash balance and defined benefit plans. Now, these are the heavy hitters. These plans allow you to contribute much more than any IRA or 401k plan. We're talking about $100,000 to $285,000 per year, depending on your age and income. So how exactly do they work? Well, these plans typically work like a pension that allows the business to make an employer contribution to your retirement plan, usually based on your age and income from the business, which means the older you are and the more you earn, the more the business can contribute to your retirement plan. For example, a 47-year-old earning $250,000 might be able to put 61% of their income, or $152,000, to a cash balance plan, whereas a 57-year-old earning the same amount of income might be able to put up to 100% of their salary into their plan, or $250,000. Now, these percentages do vary based on actuarial assumptions and plan design, but my point here is to illustrate the fact that the older you are and the more income you earn, the more you will be able to contribute or benefit from a plan like this. The disadvantages of these plans are that they are very complex, they have very strict rules and requirements. For example, unlike IRA and 401k plans, these plans are meant to be permanent and require mandatory contributions. With a 401k or IRA, we can typically decide how much we want to put in it, right? But with a cash balance plan or pension plan, you are required to put a certain amount of income towards those plans each year, or you risk compliance issues. And to that point, you usually have to commit to these plans for at least 3 years and get a third party involved to administer the plan, which will come with additional costs that you would have to consider. And if you have employees, also keep in mind that this benefit would have to be offered to all eligible employees, which can also make it very expensive for business owners with a lot of employees. These plans are usually best for high-income business owners with little to no employees at all, and they want to supercharge their retirement plans while aggressively reducing their taxes. So with all of that said, how exactly do we decide which of these retirement plans is best for us, right? Well, in general, you should consider your business income, the number of employees you have, your age, and ultimately, how much money you want to put into your retirement plan each year. If you have no employees and want to put the absolute maximum towards your retirement, you might benefit from a solo 401k or a cash balance plan. Whereas if you do have employees, you might opt for a traditional 401k plan, which may give you some more flexibility in setting your employer match percentage as well. Or if you desire simplicity, you might look at IRAs like SEP IRAs, simple IRAs, or just regular IRAs. You should also consider your administrative tolerance in terms of dealing with these plans on a yearly basis, as well as your time horizon, as some of these plans have minimum commitment periods, which we talked about, and are far more complex than others, so be sure to consult your CPA for the best guidance. And if you don't have one and need immediate assistance with this or just tax planning in general, just apply to work with my team today at mycpacoach.com.